Welcome everyone to a new episode of Finance in Focus. We're the podcast team from the Southeast Asian Finance Society, and we're very excited to bring you in-depth insights on the latest economic and market developments. I am Maria today, and joining me today are our amazing team members.
Good morning, everyone. I'm Noor, and I will cover the most recent global and macroeconomic perspectives. I'll also focus on how commodity prices are influenced by inflation and supply chain disruptions.
Hi, my name is Gasper, and I'll walk you through market performance, summarizing the key movements in global indices. I will also dive into equity research, as always, analyzing a top-performing company, discussing its recent performance, financial results, and future outlook.
And I'm Tudor, and I lead our Insight Spotlight discussion exploring a major financial trend in depth. I will also provide the week ahead, offering insights into economic data releases and other key events that could shape the markets.
Again, as always, we've got a packed agenda, so let's dive right in. Now, to kick things off, let's welcome our expert in macroeconomic events, Noor, to the table. It's such a great pleasure to be with you.
It's a pleasure to be here.
So, Noor, bring us back to the speed. What's been happening in the global economy lately? And what are the key geographic tensions grabbing headlines right now?
Well, tensions between India and Pakistan have escalated sharply following a series of military actions and retaliations as well, marking the most severe confrontation between the two nuclear-armed neighbors in over 2 decades. The recent India-Pakistan conflict has shaken investor confidence, and it caused market volatility and also may lead to currency depreciation as well, and reduce foreign direct investment.
Wow, that sounds very serious. But let's break it down. What does this really all mean for the millions of people whose daily life rely on the cross-border trade and the stability between these two countries?
Well, trade and tourism are likely to suffer, particularly in affected regions like Kashmir. With supply chain disruptions possibly raising local inflation, government spending could shift away from development toward defense, while international relations may be strained, so risking sanctions or reduced aid. Although the defense sector may seem short-term gains, the broader economic impact is negative for both countries.
Alright, and now Noor, shifting our focus more overseas, and particularly, let's say, with Canada's new leadership shaking things up. What's the latest on Prime Minister Mark Carney's economic strategy, and how is this affecting the relationship with the US?
Well, the newly elected Prime Minister of Canada, Mark Carney's economic policies focus on reducing Canada's reliance on the U.S. by diversifying trade and boosting domestic manufacturing. He plans to cut taxes for the middle class, slow government spending, and balance the budget within 3 years. Carney has scraped the consumer carbon tax but kept industrial pricing, shifting towards green incentives. He also aims to increase defense spending and invest in infrastructure to support long-term economic resilience. And we're very glad to have him in our country.
Well, that's amazing. That's very nice to hear. That's a very actually bold strategy. So, but now the things are playing out in the diplomatic front, especially with the U.S. and the Canada relationship.
So on May 6th this year, Canadian Prime Minister Mark Carney met with the U.S. President at the White House. The meeting was super intense, especially after Trump suggested Canada could become the 51st state again for the 100th time. A notion Carney firmly rejected. Trade was a major topic, with Trump pushing for tariffs, while Carney called for mutual respect between the two countries and cooperation. Both leaders agreed to continue discussions at upcoming G7 summit in Alberta, Canada as well.
Well, there's certainly a lot upholding in the diplomatic front. But shifting focus now, what's the latest in the commodities market, particularly with gold and other precious metal?
Well, this week gold is trading at around $3,343 per ounce, up over 26% year-to-date due to global tensions and strong central bank demand. Silver is about $32.42, boosted by 15% YTD growth, driven by industrial use, especially in renewables. Platinum is around $977, rising 10% this year, and may climb further if it breaks the $1,000 resistance. Overall, all three metals are performing strongly amid economic uncertainty.
Interesting. Safe havens assets really shining this year. And how is the currency market reaction to all of this volatility?
As of May 8th, 2025, the US dollar is showing signs of modest recovery after a period of decline, as we saw. The US dollar index is up approximately 0.5% for this week. The Canadian dollar has weakened against the US dollar, influenced by economic uncertainties and pessimistic stance from the Bank of Canada itself, trading at $1 for 1.3829 Canadian dollars.
Wow, the Canadian dollar seems to be under a lot of pressure.
It is.
What about the euro and the British pound? How are they holding up against the US dollar?
Well, the euro remains relatively stable against the US dollar, with minor fluctuations observed over the past week. 1 euro is around 1.1318 US dollars, while the pound has strengthened against the US dollar, buoyed by optimism surrounding a potential UK-US trade deal and expectations of an upcoming interest cut by the Bank of England. Currently trading at 1 Great British Pound for 1.3298 US dollars.
Well, that's a very interesting breakdown. So overall, we're seeing precious metals on a strong upswings, currency markets reacting cautiously to these geopolitical tensions, and some notable shifts in North American and European exchange rate. Definitely a lot for investors to keep an eye on, hey? So, thank you very much for your insightful take. So now let's hand it over to Gasper, our expert on global market trends and equity analysis, to break down the latest market actions and top equity research findings. Hi Gasper, it's always great to have you here with us to provide insights on the latest market trends. So what's your take on the latest developments in the US equity market and, well, just globally?
This week, global equity markets experienced notable volatility as investors digested central bank decisions, trade policy developments, and corporate earnings reports. In the United States, equity markets posted modest gains in their final session of the week, held by optimism around trade negotiations and a stable policy stance from the Federal Reserve. The Fed opted to maintain its benchmark interest rate, signaling a cautious but steady approach as inflation data shows signs of easing.
Oh, that sounds promising. So how did the major US indices perform throughout this week?
So the S&P 500 climbed 0.6% on Thursday to close at 5,663 points, its 11th gain in the last 13 trading sessions. The Dow Jones Industrial Average also rose by 0.6%, while the Nasdaq Composite added 1.1% to finish at 17,928.14, supported by strength in mega-cap tech names.
Oh wow, that's so great to hear. But overall, how did the markets fare across the week?
While the week ended on a mixed note, the S&P 500 ended the week slightly lower, down 0.4%, reflecting cautious sentiment as investors digested macroeconomic signals and corporate earnings. The Dow managed a modest increase of 0.1%, supported by gains in financials and industrials. Meanwhile, the Nasdaq, on its side, dipped by 0.3% as profit-taking set in following a strong run earlier in the month. The small-cap Russell 2000 edged higher by 0.3%, suggesting a tentative pickup in risk appetite among investors.
It is definitely clear that there's a lot of uncertainty going on. But any positive news that helped lift the investor sentiment?
Well, definitely, President Trump announced renewed trade talks with China, and easing chip export restrictions gave the market a boost, especially in the semiconductor space. Companies like Nvidia and AMD saw significant upward momentum as a result.
Oh wow, that's quite interesting. And how are the European and Asian markets performing in the comparison?
Across the Atlantic, European markets demonstrated relative strength. The Euro Stock 50 index rose by 2.36% this week, closing at 5,282.21 points, reflecting investor confidence amid easing inflationary pressures and stronger than expected corporate earnings. Germany's DAX also advanced, climbing from 23,086 to 23,313 by week's end, buoyed by strong industrial output data and improving business sentiment indicators.
And when we're talking about the European and Asian markets, since we want to access the global markets, how are they doing?
In Asia, markets were broadly higher, led by Hong Kong. The Hang Seng Index gained 2.4% for the week as investors welcome a new round of stimulus measures announced by Chinese authorities aimed at reviving domestic consumption and shoring up the property market. These policy moves provided a lift to both mainland Chinese equities and regional tech names with exposure to the Chinese economy.
Oh wow, and Gasper, can you just summarize it for us real quick?
Yeah, of course. All in all, while U.S. markets remain in a holding pattern amid policy uncertainty and earning revisions, both European and Asian markets displayed a more optimistic tone, driven by targeted stimulus and signs of macro stabilization.
Oh well, and let's move on now to our market spotlight, as well been wanting to see. So this week we're diving into AppLovin Corporation, a leader in mobile advertisement technology. So Gasper, what has caused such a dramatic re-evaluation of AppLovin stock from its first first quarter's earnings report, and what key factors are contributing to this surge in the investor optimism?
Well, since reporting results on May 7th, the stock has surged to $346, pushing toward all-time highs, and amid strong investor optimism, AppLovin's Q1 2025 earnings beat expectations across the board. The company posted $1.48 billion in revenue, marking a 40% year-over-year increase, while net income climbed to $576 million, or $1.67 per share. Its advertising division, in particular, was a highlight. Ad revenue jumped 71% to $1.16 billion, with adjusted EBITDA for that segment soaring 92% to $943 million. This performance confirms AppLovin's positioning as a leader in performance-driven mobile advertising, powered by its proprietary Accent AI engine.
And, wow, that's a very incredible performance. Any strategic moves beyond earnings that is driving this momentum by any chance?
Well, just this week, AppLovin announced the sale of its mobile gaming unit to Tripledot Studios for $400 million in cash, retaining a 20% stake in the buyer. This marks a full pivot away from gaming content toward becoming a pure play ad tech platform, while management signaling a sharpened focus on scalable, high-margin software.
And what's the technical outlook for the AppLovin stock, Gaspar? What are we to expect?
From a more technical perspective, AppLovin stock is currently trading above $340, having tested intraday highs of $357 around. Recent price action suggests strong momentum, with institutional buying accelerating post earnings, of course. Key support is forming in the $310 to $320 range, with short-term resistance around $360 to $365. So should momentum persist, analysts see upside potential extending to $471 per revised BTIG price target.
Oh wow, analysts are starting to seem bullish. So, but what is driving this confidence?
Well, analysts are excited about AppLovin's growth prospects, of course, noting the combination of top-line growth, operational leverage, and AppLovin's strategic realignment toward AI-driven advertising infrastructure. The company is now being compared to the likes of the Trade Desk and is increasingly viewed as a critical player in the post-identifier machine learning-based advertising future. So all in all, AppLovin has emerged from its Q1 results with renewed clarity and direction, with a leaner business model, record high margins, and a favorable setup for Q2. It definitely stands as one of the more compelling momentum stories in the market right now.
Oh wow, so let's wrap it up real quick. The US markets are navigating a very cautious path, while European and Asian markets are benefiting from the targeted stimulus and easing macroeconomic pressures. As for the AppLovin, it's one of the standout momentum stocks right now, poised for the future growth in the AI-driven advertisement space. So thank you so much, Gaspar, for the insights. And now let's hand things back over to the tutor, who's got our market spotlight. He'll dive into a major financial trend and give us the week ahead with all the key events and data to set up the market. Thank you, Tudor, so much for being here with us. And let's dive into how China has built the world's most powerful IV and bio supply chain in just 5 years.
Well, thank you for having me here. It's my pleasure, and we'll start. So, basically, it starts with raw materials. You can't build EVs without lithium, cobalt, and graphite, and China saw this early. Since 2020, Chinese companies have invested heavily in mines across Africa, South America, and Australia. They didn't just stop at owning mines, they built the refineries too. Today, China controls more than half of global lithium refining and processes over 75% of the world's cobalt.
Wow, that's a lot. And how are the Western countries trying to catch up with this China's advantage in raw materials?
They're trying to react. The US and the EU are pouring billions into domestic mining projects, but these take time, usually 5 to 10 years. So for now, China owns the upstream advantage, and that's not changing overnight.
So how has the Chinese control over this battery production shaped the global IV market?
Well, as of 2020, China produced about 3/4 of the world EV batteries. Companies like CATL and BYD are giants building massive factories, producing at scale and selling to the automakers around the world. These firms didn't just benefit from the demand, they shaped it. Their scale drives down costs, which makes batteries cheaper, which then pushes EV adoption higher.
And what challenges are these Western battery manufacturing facing compared to these China giants?
Western battery makers, some are promising Sweden's Norvolt, but the delays cost overruns have held them back. Many car companies in the US and in Europe now find it faster and cheaper to just partner with Chinese producer instead of building their own from scratch.
And how did Chinese car brands go from battery known to dominating the global EV market?
Just a few years ago, Chinese car brands were barely footnote. Now they're the largest EV producers on Earth. BYD even passed Tesla in total unit sales in 2023, if you count plug-in hybrids. Domestic EV sales in China have exploded. About 30 to 40% of the new cars sold are electric, and Chinese brands are now shipping cars all over the world.
Wow, that's quite interesting. So what's behind this huge spike in the EV export from China, and how is it affected, for example, Europe?
They've gone through the roof. Between 2020 and 2023, EVs exports grew by over 850%. A huge share of those went to Europe, where brands like MG, now owned by Chinese SAC, and BYD are gaining ground fast and affordable, good quality models. Europe's worried it's even launched an investigation accusing China of dumping EVs below cost. But this isn't just a trade story, it's also a tech and policy story. The global push for clean energy is massive. EVs are the center of that, and China's positioned to benefit the most. On top of that, Chinese firms aren't just building, they're innovating. They've improved battery safety, reduced cost, and brought new chemistries to market faster than many expected.
And Tudor, given the current political tension, I'm just wondering, what's the global reaction to the China's EV dominance, and how are the countries, if they're trying, to push back?
Of course, there's a growing backlash. The US passed the Inflation Reducing Act to cut China out of EV supply chain. Europe has similar plans, and countries like India, Japan, and South Korea are trying to build their own ecosystems too. But the truth is, China's 5-year head start is hard to beat. Building battery plant takes years. Building trust, supply chains, and the global scale takes even longer. That's the situation as we head toward 2030. On one side, China vertically integrated, fast-moving, and deeply invested. On the other, a mix of countries trying to catch up, driven by national security concerns, climate goals, and competitive pressure.
And we're talking about the EV market and what's not. So I'm just wondering, why should investors be interested about China's role in the global EV markets?
Well, for investors and anyone watching global markets, this is one of the most important stories of the decade. It's not just about EVs, it's about who controls the building blocks of the future economy and whether the rest of the world can keep it up.
Alright, and now let's take a look at what is shaping the financial markets this week.
All
So, what economic trends are we seeing this week that investors should be paying attention to?
We're coming off a strong retail report in the US. Consumer spending jumped 1.4% in March, well above expectations. That spike looks like people were rushing to buy before new tariffs kicked in on April 5th. But zooming out, there's some tension under the surface. Industrial production dipped at 0.3% and housing starts fell hard, down over 11%. So while consumers are spending, factories are cooling off and new home construction is taking a hit from rising costs.
And how are things looking in Canada and Europe right now? And what are the central banks doing about it?
Canada had a softer inflation, reading 2.3% in March, down from 2.6% in the month before. That helped justify that Bank of Canada decision to hold rates steady at 2.75%. Meanwhile, in Europe, inflation cooled slightly to 2.2%, and the European Central Bank followed through a 25 basis point rate cut, dropping the deposit rate to 2.25%. They hinted a more easing ahead, pointing to the weak growth and the global uncertainty triggered by tariffs. The UK followed a similar path. Inflation dropped to 2.6%, and with job market slowing down, the Bank of England is likely to sit tight for now.
Oh wow. And what's going on in, let's say, China and Japan economies with all this trade tension and inflation issues worldwide?
Well, in Asia, China came hot. First quarter GDP was 5.4% up year over year, beating forecast. Industrial production and retail sales also surged, likely boosting consumers and business front running the impact of tariffs. But even with this strong start, analysts are warning that the real hit from trade tensions may come later in the year. Japan, on the other hand, is dealing with persistent inflation. Core CPI hit 3.2% in March, and industrial production posted a solid 2.5% increase. That puts the Bank of Japan in a tight spot. Inflation is above target, but growth remains shaky.
And what are we hearing about companies? For example, let's say Johnson & Johnson and Netflix with their earnings report.
Johnson & Johnson kicked off the week with a strong performance. Quarter 1 revenue 21.9 billion and earnings share of $4.4. That's well above the last year, partially thanks to one-off gains, but still impressive. All eyes are now on Netflix, set to report after markets close on 17th of April. Subscriber trends and future guidance will be key, especially with rising content costs and global competition heating up. Also in the spotlight, Goldman Sachs, reporting on 14th of April and expected to set the tone for the broader financial sector.
So, since we all live in Spain, I was wondering what is the outlook, the financial outlook in Europe?
Well, in Europe, the earnings calendar is quieter, but we're watching big players like Shell, Volkswagen and HSBC in the coming weeks. Meanwhile, in Asia, Samsung already reported record sales. KRW 79.1 trillion in the first quarter, driven by strong demand for chips and smartphones. Profit margins are under pressure thanks to the competition and tariffs. That'll be the theme watch as more Asian tech giants release updates later this month.
And how then going trade tension, this tariff that you mentioned before, and regulations are affecting the market right now?
Well, on April 5th, the US slapped the blanket 10% tariffs on all imports, with some goods facing up to 50%. China's retaliation has been fierce. Duties on US goods now exceed 125% in some cases. The IMF flagged this escalation as a top global risk, warning that trade shocks are feeding the financial instability. Market sentiment this week will be especially sensitive to any headlines around negotiations or possible tariff pauses. We already saw some relief when reports suggested a 90-day delay on broader enforcement, but nothing locked in.
And what's the big picture for the global economy this week? And what could it mean for the markets?
Well, the bottom line, the global economy is sending mixed signals. Consumer spending is strong in the US, inflation is easing in parts of the world, and China's growth still looks solid for now. But the drag from trade wars, shaky housing data, and sticky inflation in countries like Japan is keeping central banks cautious. That means more volatility ahead, and investors will be hanging on every data point, earnings report, and trade update this week.
So, to sum it all up, China has made huge strides in dominating the IV market, from securing raw materials to leading the battery production and car export. Despite the pushback from the West, China's head start is too tough to overcome, and its innovations are shaping the future of the global clean energy. It's a game-changing shift, and investors will need to keep a close eye on how this plays out. We have explored global market trends, but now let's turn our attention to something closer to the home, the Sada Student Finance Society and its efforts to help students sharpen their finance and investment skills. With several exciting events taking place, now is the perfect time to get involved. So first of all, on the May 7th, we wrapped up this year's events with the much anticipated Asada Finance Summit, now in its 4th year. Attendees had the incredible opportunity to explore top industries like investment banking, private equity, and wealth management, while engaging with some of the biggest names in the finance world, including Goldman Sachs, Morgan Stanley, Lazard, Deutsche Bank, and Summa Capital. This summit provided invaluable networking opportunities and insights from the industry leaders that will empower students to take their next step towards a successful career in the finance. So let's wrap up this week. First of all, Noor analyzed global macroeconomic trends, focusing on the impact of tension between India and Pakistan, as well as US-Canada diplomatic relationships. This shift has significant effects on the market dynamic worldwide. Secondly, Gaspar highlighted the US market volatility, with particular attention to growth trends in European and Asian markets. He's also examined AppLovin's impressive performance in the face of the economic fluctuations. Finally, Tudor discussed China's rising influence in the electric vehicle and battery supply chain, which is reshaping global manufacturing. This trend positions China as a dominant force on the future technological advancement. As always, staying ahead of these shifts is a key to making informed decisions. Thank you so much for tuning in, and we'll see you next week with more insights and analysis.